Telling you about the potential for stocks to move up or down, and that's sort of the implied, and then realized volatility is what actually happened, right? So when you think about the potential distribution of stocks in a sort of elementary framework, they can go up or they can go down. But what causes them to go up or down? And how do you assign probabilities to each of those movements? And then as you propagate out on what would be referred to as a binomial tree, you start to get probabilistic determination of movement in stocks. But where the default comes in that I think is extremely important is that there's a concept called a trinomial tree, which is used in stochastic credit modeling and some other more high-level scientific estimations of credit spreads and equity pricing. But to speak about it in plain English, because I'm not a PhD, I always have to translate this stuff for myself from people who are smarter than I am. You really have to consider, what's the potential that this company fails, right? You've got the potential that it goes up, you have the potential that it goes down in an organized statistical fashion, and then there's the potential that it fails. And there is also other, events like a takeover or, things like that. But the big three are up node, down node, and jump to zero. A newfound form of cheapness in stocks for large quantitative firms over the last 10 years has increasingly and in different waves been high default risk stocks. Because if you say that a stock is intrinsically cheap by 20% because the market is overestimating its chance for failure, and you lop off that third node or assign it a probability of zero, all of a sudden it's cheap, right? So when we watch investor behavior in the market and we see how this plays out, there have been different waves where default high dividend stocks would perform very well on a relative basis, and then they sort of change their focus. I say they, like large institutional equity buying, changes the focus from buying or chasing dividend yield to all of a sudden accumulating and pushing up the relative performance of risky stocks or high default risk stocks. It's something that we observe on a daily basis. I've continually been frustrated that people aren't focused enough on this, and that's why this topic sort of knocked me off my chair as this is an opportunity to talk to a broader audience about why corporate insolvency default probability actually matters for equity investors.
Well, I think the clearest example of this is some of the ways that companies have declared bankruptcy and the stock has gone up because people are. It's essentially they're buying the news, or buying the rumor, or thinking that it's just a rumor. I don't know how to think about it. I mean, Hertz is one that comes to mind. Are there any good case studies of this from the past few months that you think perfectly exemplify this problem of the market just totally disregarding insolvency risk in its pricing of equities? And then I think we should talk as well about credit spreads and how that plays in too, because it starts there. It starts in the credit spreads and then it plays its way into the equities.
It does. And, it's a really confusing mix of components, and it's not the same, to your point of a couple of examples, it's not the same for every company. So for example, PG&E is a complicated situation where they've been on, the doorstep of bankruptcy or insolvency for years. But one of the most attractive assets that PG&E has is they have a huge pile of tax write-offs, of losses that whoever acquires them can use as a tax offset on an ongoing basis. So the equity is actually worth something because of the tax benefit of all of the losses they've accumulated. So you bring up a good point, which is that you can't paint with a broad brush across all scenarios. You have to sort of think about it, in idiosyncratic terms or in different buckets. So some of the very high profile insolvencies have strange nuances to them. I will say that from my personal experience, one situation that shattered the precedent for bankruptcy and the relative positioning of equity stakeholders versus credit stakeholders was General Motors, in 08, 09. So, the way things shake out now, it's a little bit different. Hertz, people's idea around Hertz is that Hertz is not going to go away. It's a valuable brand. They will survive. They will carry on. It's just a matter of who's going to take the markdown. And are the equity stakeholders going to get wiped out and the bondholders get recovery, on the assets, and then they move forward with a reorganization, or will they bail out the equity stakeholders and the debt and move forward? It's sort of, it has a lot to do with the incentives of the current stakeholders of the company and who wants to come in and try to take control and reorganize the company. What I think is more important to broader equity universe or equity investors is, the stuff that's not big, high profile bankruptcies, things that are part of the high yield index. And what we look at, there are a number of factors that you can look at to observe this. But maybe the best one that everybody has access to is the Russell 2000, right? It's an index of 2,000 stocks that are relatively small cap. So if anybody wants to look at this at home on any service, you can spread the differential of performance between the Russell 2000 and, say, the S&P or the NASDAQ, and take a look at that. And the way that I describe it is that when people are looking to add risk to their equity portfolio, but not change the amount of risk they're taking in dollar terms,
Many thanks, as I'm humbled already by everyone's support. Appreciate you.
I'm just
Interested in stock investing, M1 Finance is offering a special limited time promotion. If you sign up with my M1 Finance referral link, which is also in the video description, and make a $100 deposit, both you and I will receive $30.
4 free shares of stock when you open an account and make your first deposit.
Totally free. You can just stock like Microsoft, Visa, Johnson & Johnson. All you gotta do is sign up for my link down in the description, sign up for Robinhood. All you gotta do is fill out some information about yourself and link your bank account, and literally that's it. That's all you gotta do.
Hey, I'm actually a nice person.
Light up that like button, or smash the like button. Regardless of which metaphor you prefer, this small action really helps me grow the channel, and I appreciate it.
Hey, thanks. Have a great day.